Let's make investing fun. The objective of this video and the series of videos that I will be making on WalletWise will be not just about investing in general, but understanding why you have to invest and the long-term advantages of investing in the stock market, mutual funds, and different portfolios, how you can build your asset classes. And this video will be specifically targeted for beginners in their investing journey. So if you're someone who's a seasoned investor who's put in a few lakhs, crores, whatever, you understand how the equity markets work already, this video might not be for you. But if not, if you're new to your investing journey, if you want to learn how you can maximize your returns in the long run, if you want to see how you can make money through the stock market in a passive way, then this video is meant for you. And in this video, we will be talking about the basics of mutual funds, understanding terminology of what to invest, why to invest, there are a bunch of words that we keep hearing. And those terminology will be explained where you could put your money, where you should not put your money. And that will be the crux of this video. I'm Surya from WalletWise. If you haven't subscribed to my channel already, a subscription would be great. Like the video, share it with your friends. And this will be a beginner's course. So if you believe that you already understand investing and you're like thoroughly, well knowledgeable about the world of investments, then probably this video is not meant for you. But otherwise, stay tuned. We have a lot of information coming about mutual funds specifically. So let's jump in without wasting any time. Let's look at what a mutual fund actually is. When you want to put your money into the stock market, the first question that comes to you is that money safe? How much should I invest? Will my money remain or will it dwindle in value? Now, where does a mutual fund come into these investments? There'll be another video I'll be making about stock market basics, but that will come to later. But before that, let's try to understand what a fund is. Since I might alone not be able to buy a share, so let me give you an example of a share like MRF. The current price of MRF is about 58,000 rupees. Now, I would need to put 58,000 rupees to buy one share of MRF or 2,000 odd rupees to buy one share of Reliance as on today. To the contrary, if I am putting money into a mutual fund, let's say I add 1,000 rupees into a mutual fund, they would collect another 10,000 or 2,000 or 5,000 from Ramesh, another 20,000 from Sheila, 10,000 from Neha, and different people would together make that fund. And there will be one person who is called the fund manager. And this fund manager will be managing the portfolio that all of you have put. The money that you have together pulled in is called AUM or assets under management. You'll be surprised, rather shocked to know that 27 lakh crores of money is today invested in mutual funds. Let that number sink in for a minute. That's the kind of potential that this investing tool has for you. When you mean an asset management company, what is it? You would have heard of HDFC Asset Management, or you could have heard of ICICI Asset Management Company or Franklin Templeton. There are a bunch of these companies. What these companies do is that they hire professional fund managers to identify who have different approaches towards stock market investing. And by the way, the great thing about mutual funds is that it is not just for stock investment, but they invest into gold, they invest into bonds, they invest into real estate, into every single asset class. For example, government securities. All of these asset classes are covered by mutual funds. There's no rule at the same time that each fund will put in money into all of these asset classes. You have separate funds for all of these. So you could have a pure equity fund, you could have a balanced fund, you could have a diversified fund that puts in its money into different asset classes to reduce your risk. So keeping your objective in mind, you have like a bunch of options right in front of you. Once we understand what an asset management company is and the assets under management, AUM, that's the short form for that, then we come to another word that is quite common that we would have heard, that is called NAV. So what is this NAV? If you're putting money into a mutual fund, you should understand that this money is being pulled in from different people and you are being allotted units for your investment. So let us say I have put in 1 lakh rupees into HDFC Asset Management Company for a particular fund. This 1 lakh rupees, for this 1 lakh rupees, I am allocated X number of units based on the value that that fund has. So it could be 20 rupees, it could be 30 rupees or 100 rupees. That keeps changing because just how the stock market keeps changing prices, the NAV of stocks also change on a daily basis. Once we understand what NAV stands for, let's look at another interesting concept called a NFO, a new fund offering. So whenever a mutual fund decides to launch a new fund manager, they have a new ideology, you should understand that each AMC or fund management company has dozens of funds. And not all of these funds are recommended, are not meant for everyone. For example, if they want to make a IT related mutual fund, only IT related stocks would be put into that particular mutual fund. Similarly, if I'm looking to make a small cap, that is a mutual fund that is only targeted for looking at small companies, then they make a small cap fund. So whenever a new fund is being offered, it's called an NFO. And NFO has an interestingly 10 rupee face value only. So if you're buying 1 lakh rupees into a NFO, you get units allocated at 10 rupees per unit. Now, when you buy a fund, which is not a NFO, but probably has been there for 2 years, 5 years, you should understand that the NAV will be then higher. It could be lower also for that matter, if the market falls. So instead of 10 rupees, you might be buying at 20 rupees, 30 rupees. So this would be the gain that you would have in this period. So once we understand this concept, then you should understand how you can put your money into mutual funds. Is it necessary to put a lump sum or a large sum of money at once? One great thing about mutual funds is that you do not need to put all your money at once. I'm not sure that I'm educated enough to speak about diversification at this juncture. But that said, you have the advantage of diversification with mutual funds. And you do not need to keep all your money into one fund. You can put 10% into an aggressive, fast-growing small cap fund, but you can have 50% of your money into a large cap fund, which is basically targeted for the larger companies. SIP stands for Systematic Investment Plan. Now, the beauty of systematic investments is that you can create an authorization with your bank for as low as, listen to me again, 500 rupees. Let's say it again, 500 rupees per month. That's the least you can invest. And it can go up as much. And the beauty of this is that this every month is deducted without my knowledge from my bank account. You can create an authorization for that. You are not controlling every single transaction. Imagine what happens when you control that transaction. You're kind of afraid. Oh, will this money go up? Oh, whatever I've invested has gone down. So in a systematic investment, you are only looking at the extreme long term, 10 years, 20 years, 30 years, that kind of time frame. And you cannot go wrong in the stock market in that time frame, 99 out of 100 times. Just like systematic investment plan, which is called SIP, there's another option you have called a systematic withdrawal. In the case of a systematic investment, every month you are debiting your bank account and crediting your mutual fund account with money. In the case of a systematic withdrawal, you are withdrawing funds from your mutual fund account every month. So how this works is that, let's say your fund has been performing well, it has been growing in value. You can put up a systematic withdrawal saying that, okay, fine, today I have 10 lakh rupees in my bank account. I'm going to put a withdrawal of 10,000 rupees per month. So that would translate to 1,20,000 rupees of money has been withdrawn in 1 year. But you should also remember, if the fund is performing well, that remaining money is still compounding. A systematic withdrawal is a profitable solution for people who are looking for an ongoing income kind of solution. That's whom I recommend it for. Another question that people keep asking is that, are mutual funds truly free? Do you have a cost to put your money in there? It's a very interesting question because there really is no evident cost. As in, when you put 1 lakh rupees into a mutual fund in India, that 1 lakh rupees gets invested 100% into that fund. To the contrary, in many other countries, there is something called an entry load. So while you're investing money itself, your banker receives a commission, sometimes your stockbroker receives a commission, or it could be the load being charged by the asset management company, where they charge you 2%, 3%, 5%, whatever entry load they want. In India, no mutual funds can have an entry load. but they have something called an exit load. So if you are exiting the fund within, say, a period of 1 year in the case of equity funds, in the case of liquid funds, which are basically investments into short-term debt and treasury bonds and stuff like that, which can be liquidated very quickly. In such a case, you will be charged a exit load if you withdraw your funds within 7 days, within 10 days, the different numbers over there. Similarly, there's another cost called as an expense ratio. Your asset management company that is managing your portfolio charges you anything from 1%, 0.5%, 3%. It goes all the way up to 3%, by the way, for managing your fund. So please remember, this is for managing your fund. It doesn't matter whether the fund is increasing, decreasing, has been stagnant forever. Even if you have lost money on this particular investment, your AMC, that is the asset management company, will keep taking money out of your fund. In the long term, it could pay off, absolutely. However, you must understand that in the short term, you can be on the losing side because of just this expense ratio. Many of us put our money with our bankers because we assume they're people that are well-wishers and they, believe that we should have a portfolio. What bankers offer to you is that have a relationship with us. When you mean a relationship, have fixed deposits, have mutual funds, have blah blah, all these kind of investments with us. We'll give you X privilege, we'll give you Y privilege. For example, if I could take Kotak Bank, will give you, say, if you give us a asset management portfolio worth, say, 10 lakh rupees, we'll give you a premium bank account. So many of us put our investments in the beginning not knowing what happens over there. Here, banks charge you an additional 0.5%, 1% of the asset management. So that's a commission that goes to them on an annual basis. So apart from what the asset management company is charging you, the banks also receive a kickback or a commission for this. In the US, you have both these options, wherein the entry load exists, but the expense ratio is lower for some funds. At the same time, you can also choose for zero entry load, but high expense ratio. In India, because of whatever reason, SEBI has decided that the entry load should not be there, but maintenance charges can exist. And hence you have a situation where 2 to 3% of your portfolio could be lost every year, irrespective of whether you make money or not. Please remember, it's not on your growth that you are paying this, but you are paying this on the asset value. What other costs exist? There really are no costs apart from this. This is the entry load, the exit load, and the asset management fee, which is also called as the expense ratio. You should remember that the expense ratio is very, very low for certain kind of funds. And those are the kind of funds that I recommend personally. I would, for example, if you're putting your money into debt funds, if you're putting your money into gilt funds are nothing but funds that invest primarily into government securities. So they buy treasury bonds issued by the RBI or by the government of India, and only those investments are done by those funds. You also have low expense ratios for some equity funds, especially what is called an index fund. Now, in an index fund, you can go through my video over here about index funds if you want to understand them thoroughly. But an index fund is basically a replication of the Nifty 50, or sometimes it's the banking index or different indexes, and they just replicate it. The fund manager does not need to bother about doing research about which script is performing, where to buy, when to buy. He's not bothered about that. All he does is that whatever is the weightage of each share in the Nifty 50, he will buy that, he will deploy his funds in the same ratio. So for example, let's say HDFC Bank is worth 8% of the Nifty 50 today. He would deploy 8% of his money, the assets under management, into HDFC Bank. That's it. If Infosys is worth 5% of the Nifty 50, then 5% of the assets under management is put into Infosys. Now, what happens in this case is that whenever there is a company that is removed from the Nifty 50 or there is a new addition to the new Nifty 50, it is automated. Whatever is the price that day, your fund will sell your money and again buy on that given day the new company that is being brought into the index. So you are not trying to beat the market, you're trying to match the market. To be honest, in the long run, what happens is that many mutual funds don't even beat the market, considering that you have a 2%, 3%, much higher sometimes, expense ratio. you kind of be on the losing side on several cases. However, in bullish markets, well, everything works out and you will make money. I'm not at any point trying to say mutual funds are bad. I'm actually going to do another video which is going to be about why you should put your money in mutual funds, the advantages, the pros and cons thoroughly. But this video is primarily to help you understand what a mutual fund is and any core ideas that are there inside mutual funds, the explanation. That's the purpose of this video. How do you put your money in mutual funds? Now that's $1 million question. Where should you put your money? There are multiple options that you have. One, you can go to your banker, either online or offline. Some of you will have, if you're for example having an HDFC bank account, inside your net banking you will see a mutual fund option right at the top and you can invest through that. Similarly, if you have a stockbroking account, you can purchase mutual funds through your stockbroker too. Would I recommend investing through your banker or through your stockbroker into a mutual fund? I absolutely do not. The reason is very simple, because along with the expense ratio that the asset management company is charging you, your bank is extra going to charge you another 0.5%, 1%, 2% extra. So what that means is that irrespective of whether your fund increases, decreases, your investment can remain stagnant for 5 years at a stretch, but your banker will keep charging 1%, 2% extra on your fund along with the asset management company. So if you're going to lose, say, in a stagnant market for 3 years, if you leave your money just like that, you would have probably lost 6-7% on your investment. So how can you avoid this? With the power of smartphones, you have a bunch of applications that are offering what we call direct mutual funds. In a direct mutual fund, you can bypass the banker, and the application like, for example, Paytm Money or Kuvera or Coin by Zerodha, there are a bunch of other applications too. They charge a very nominal fee. These companies will let you invest directly into the fund. You will not be paying any additional fees, but only the fees charged by the AMC. Are mutual funds a great investment tool? To be very honest, when you look at the sheer number, 27 lakh crores of money is today invested into the stock market, into different debentures, into gold, into real estate also, through mutual funds. So as a vehicle, it has great value. That is undeniable. Is it meant for everyone? That's a question that you should ask yourself. Are you a beginner? Are you not willing to fall a few times and burn your money, or sometimes take unwise decisions? Then mutual funds are a safe bet. But that said, my next video will be about 13 reasons why and why not you should put your money into mutual funds. There I'll be delving into deeper issues as to why mutual funds might not align with your long-term investment objectives. So once you're done with this video, do not forget to go through the investment playlist that I have over here, and you will find this video about 13 reasons why. And please go through that video too, because that will be like a continuation from where this ends. Thank you so much for your time. I hope this video has been educative and informative. I tried to be entertaining, but I'm not still there. Probably a few more videos and I'll be at a stage where I'll be able to joke and make this a lot more entertaining and fun. As I said, the objective is to make investing fun. In the long term, I hope to make this something like, wow, oh, this is so easy. Investing is fun. That's how this should be. Wallet-wise, thanks you for this video. Thank you for your time. Have a good day. Like this video, share it with your friends, and subscribe to our channel. Bye-bye.